Investing is a fascinating area, but it should be done on the basis of a strong understanding. Many people invest before they have the understanding. It's not like going to a casino. It's not a game of chance. And the lower the prices go, the more eagerly they sell. This is wrong. Mm-hmm. What we want to do is buy low and sell high. Human nature causes us to buy high and sell low. At minimum, we want to avoid it. And at maximum, we want to do the opposite. Now, it's not easy, because what you have to do is you have to restrain your enthusiasm as things are positive, and you have to turn more positive as things are negative. Very hard to do. It's time, not timing, that produces success. Just put your money in and let time pass.
From all over the country and the world to our investors who have been waiting for this, he's considered a pioneer in the American investment world. Today we have the pleasure of having Howard Marks, chairman of Oaktree Capital, with us. Welcome.
Thank you. Well, I'm very glad to be here and contribute what knowledge I have.
Chairman Marks, I recently read your investment letter. As someone who studied econometrics, I found many of the statements quite shocking. It was full of criticisms about economic forecasting and econometric methodologies. I'm curious about the background to that.
This is quite a dilemma. What is investing? Investing is positioning capital to benefit from future events. Mm-hmm. And yet, I insist that we can't know the future. How can we invest? And what the important conclusion from that is that you must not assume that you know what the future holds. If you admit that you don't know what the future holds, mm-hmm. then you will invest carefully. You won't bet too heavily on one outcome. You'll spread your risk, diversify, hedge, and have a mixture of investments. Mm-hmm. The great American humorist Mark Twain said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." Mm-hmm. And I think this is very important for your viewers to consider. No sentence that begins with, "I don't know, but," or "I may be wrong, but," ever got anybody into trouble. You get into trouble when you say, "I'm sure that this will happen. I'm certain that that will happen." Because if you are too confident and you bet too much on one outcome and you're wrong, then you can fail. If you admit uncertainty and balance your bets over a number of scenarios, it's highly likely that you will succeed. People rely on forecasts because they do not like to live with uncertainty. There's a quote in the memo: if people didn't have forecasts, something like, if people didn't have forecasts to rely on, they couldn't get out of bed in the morning. It's terrifying to know that you have to live in a world that is unpredictable. But it is, in my opinion. And you have two choices, in my opinion. You can say, the world is unpredictable and we're going to accommodate to that, or we're going to live by predictions. One of my friends, the day the memo came out, one of my friends said to me, "Yes, but you have to take a position, don't you?" My answer is, you don't have to take a position. If there is an event mm-hmm. and you have no reason to believe you know what the outcome is going to be, then you shouldn't bet on that event, or you should hedge that event. When Oaktree makes its investments, we merely assume that we don't know what's going to happen in the economy or in the markets, and we we take actions which allow for that uncertainty. We all have opinions. I rail against forecasting, but I have opinions. I just don't bet heavily on my opinions. It's one thing to have an opinion. It's something very different to be confident that you're right. And I'm never confident that I'm right. Where we believe we can be right, where we can get an edge and produce superior performance, we hope, is in what I call the micro, not the macro. Macro, for the benefit of your viewers, is countries, economies, currencies, commodities, interest rates, and markets. And really, nobody knows those things better than anybody else. The micro, companies, industries, securities, these are things that through hard work and skill, I think you can get an advantage and do a superior job. So that's where we put our emphasis. But if that is where we're experts, then we shouldn't be betting on economies and interest rates and currencies.
Since 1969, for about 50 years, you've been active in finance and investment. If you were to divide those 50 years into periods, your philosophy, techniques, and strategies must have evolved. How would you categorize those periods? And what stage would you say we are at currently?
Well, as you indicate, when you say 50 years, it sounds very daunting. It's a long time. It didn't feel like 50 years. But yes, I have lived through a variety of periods, cycles, maybe divided by crises. You know, things are down, up, down, crisis, up, crisis, you know. And I have, my career has been punctuated by 4 crises, 1991, 0102, 0809, global financial crisis, and of course the pandemic. And so for every strategy, for every investment approach, there are times that produce a lot of opportunity, and there are times that are what the farmer would call fallow, slow periods. And you have to know the difference. And you have to wait patiently until the opportunities come along, and then you have to move aggressively to take advantage of the opportunities. And once you do so, and they make you money, and the markets recover, then you should step back again and become patient once again. It's wrong to think that there are always great opportunities. Sometimes there are not. And I believe that the availability of opportunities depends on the market. And it depends, most importantly, on the behavior of other investors. We've gone through a long period from the middle of 2009, the end of the global financial crisis, to early 2020, the beginning of the pandemic. We were in a period where the central banks provided easy money, interest rates were low, financing was easily available to anybody who wanted to get money. People were eager to provide the money. Buyers were enthusiastic. Sellers were complacent. They were not eager to sell. Risk aversion was low. Fear was low. The greatest fear for many of those years was what we call FOMO, fear of missing out. When the market is in this condition, nobody's selling eagerly. Why should prices be low? They shouldn't be. There are no bargains in that climate. That is a time for caution. And you must recognize what's going on. I wrote a memo to my clients in February 2007 called The Race to the Bottom. And it talked about what happens when people have too much money and they're too eager to invest. The opportunities deteriorate. You have to understand the conditions that you're in. And then, usually, they take on too much risk. The structures that they build are too risky. Something happens. Some trigger event, and it collapses. Now, everybody's terrified, and nobody's eager to buy. Everybody wants to get out. Fear of losing money replaces fear of missing out. And this is the time when bargains are readily available, but you need the courage. You have to understand what's going on, and you have to have the courage to take advantage of those bargains. And so if you accept that the market fluctuates in this way, cycles we call them, then clearly it's not wise to behave the same all the time. You have to vary your behavior commensurate with what's going on in the cycle. The goal is to be counter-cyclical. Normally what happens is when things are going well, economic reports are good, companies are reporting good profits, stock prices and security prices are rising. People feel good, they buy. And the higher they go, the more they buy. Then they reach a maximum for some reason. Maybe there's a negative event, or maybe the economy just turns down and the economy is deteriorating and company reports are not as good and stock prices are falling, and now people get depressed and they sell. And the lower the prices go, the more eagerly they sell. This is wrong. What we want to do is buy low and sell high. Human nature causes us to buy high and sell low. So that is what I call pro-cyclical behavior. At minimum, we want to avoid it. And at maximum, we want to do the opposite. Now, it's not easy, because what you have to do is you have to restrain your enthusiasm as things are positive, and you have to turn more positive as things are negative. Very hard to do. Some professionals can do it, not too many amateurs can do it. But at minimum, you want to not be emotional and not succumb to the cycle. So rather than buy high and sell low, maybe you say, I'm just going to hold throughout, you see. So that's obviously better than being pro-cyclical. Of course, the best thing in the world is to be counter-cyclical at the right times, but it's not easy. And people should not try with the money they need. But anyway, my career has basically consisted of these cycles, and this is why I wrote a book on mastering the cycle, which I'm proud to say is available in Korean. Not that I'm trying to sell books, but investing is a fascinating area, and it's a potentially profitable area, and I recommend it highly, but it should be done on the basis of a strong understanding, and not too many people invest before they have the understanding. And it's not like going to a casino. It's not a game of chance. It is a serious pursuit that should be followed on the basis of knowledge. In which case, you can count on having a good outcome if you do it wisely. The other thing I want to say about the periods of my life is I came into the investing business, as you indicate, 1969. And we all know, that the young people will tell you, that was a dumb world. Nobody knew much. Most people didn't understand how the market works, what makes for an attractive stock or bond. Most people did not have access to information. If you wanted to study a company, you had to send them a letter and ask for the annual report. And then they had to send it back in the mail. It took a long time. And it was easy to get a knowledge advantage. just through a little effort. Warren Buffett talks about buying dollars for 50 cents. That's a good thing to do, but it relies on other people who don't understand that those are 50-cent dollars. Fast forward to today. Now everybody has a computer. Everybody's hooked up to the internet. There's lots of data feeds. Everybody understands how the market works. Now the world is a smarter place. And knowledge is cumulative. Everybody knows everything today. So my son pointed out in one of my memos called Something of Value, January of 21, that readily available quantitative information about the present will not be the source of superior profits because everybody has it. In order to have superior profits, you have to have some advantage. You have to know something that the other people don't know or do a better job of interpreting it. And so it is competitive and challenging. So what we say in the terminology of our profession is that the markets have become more efficient. The markets now have more information and do a better job of incorporating it. So I would say that it has gotten more challenging over my lifetime. When I started, I joined the industry in '69. I started managing money in '78. I started with high yield bonds. Most people didn't know about them. Most people didn't understand them. Most people were afraid of them. So it was possible for me to get a bargain. Today, all that has changed. Now everybody knows about them and nobody's afraid of them. So why should they be as cheap as they used to be? And the answer is they shouldn't. The market has become more efficient. So I noticed that you have copies of my first book here called The Most Important Thing. And there are 20 chapters, and each one says the most important thing is, and then it's a different thing. Because in investing, there's no one important thing. There are many, and balancing all the considerations is one of the things that makes it challenging. But chapter number 2 says the most important thing is understanding market efficiency. You have to understand the concept that I just explained, and the change in efficiency has been a big marker in my career.
In Korea, you're regarded as a master of contrarian investing, and that's how you're seen. You're known for your great success using a strategy of taking positions opposite to the market. Has it been about 7 months since Mr. Kang interviewed Chairman Marx?
That's right, about 7 months.
I saw it then, and I watched it again to prepare for this interview. Even back then, when the market had a 10% correction, you said that it was a healthy adjustment and there was no need to leave the market. But the situation is more serious now. Many tech stocks and platform companies have fallen another 30 to 50%. So I'm curious how you view the current market. Since the market has worsened, do you think it's time to actively buy stocks? I'd like to ask.
The only thing I know for sure is it's a better time than a year ago or 2 years ago. The market was very high. Surprisingly, after the pandemic, the market was very high because the central banks of the world came in so strong with the rescue that they made the economy stronger and they made the liquidity very available. And that produced asset prices that were very high. And in the last year, prices have been coming down. And as you say, I said, a healthy correction, not over necessarily. There's no reason to think that this is the bottom. Prices were very high. Now they're moderate. They're not terribly low. These are not bargains we're talking about. These are reasonable prices. Nobody can say whether it's going to go lower. It may well. Your question, part of your question is this the chance of a lifetime? No, it's not the chance of a lifetime. It's a reasonably priced market. Now, I believe that most investors should be invested most of the time. The idea of being able to get in and get out and get in and get out, what we call market timing, is not a good idea for most investors. It's very hard to do. you have to understand the market, you have to understand the economy, you have to study your psychology, and you have to operate against your psychology. You have to buy when things are really bad and sell when things are really good. This is hard for most people. So I don't think that the average viewer should try market timing. They should invest either all the time or almost all the time. Now, it would be great to try to reduce your risk when the market is really high. Hard to do. Maybe worth trying, but that's about it. And market timing, most of the time, is too hard to try. Now, when I was working on my book about the cycle, I said to my son, who is a very important sounding board for me, I said, you know, I think my market calls have been correct over my career. And you know what he said to me? That's because you did it 5 times in 50 years. This is a very important concept. And, you know, he looks at all these questions with fresh eyes and makes great observations. 5 times in my life, the market was here or here. And on those occasions, the error was obvious, the argument was compelling, the chance of being right was very high. Here or here. What about here or here or here or here? In between, it's not so obvious. And the chance of being wrong is quite substantial. That's why people should not try this on a regular basis. And we don't try on a regular basis. We don't change from month to month or year to year, only in the extremes. And you know, and we're professionals, and we think we understand the process, and yet we don't try that often to time the markets. And think about it this way. Let's say I told you that the market is 10% overvalued. Let's say I'm correct. What's the probability that it's going to go down over the next year versus up? My guess would be 55 to 60%. It's very common for the market to be overvalued and go up further. And in fact, if the market went down every time it was 10% overvalued, it would never get to 20% overvalued or 30% overvalued or 40%. And we've seen those gains. And we would never have bubbles, which we do from time to time. So clearly, overpriced and going down tomorrow are not synonymous. And so I think for most people, market timing is not the solution. For most people, the answer is understand investing, figure out a rational way to do it, whether it's picking good companies or going into funds or hiring a manager or something like that. Don't expect too much, you know. I go to people, I say, I think we can make you 8% a year. I think we can make you 12% a year. With our riskier products, I say maybe I think we can make you 20% a year. Then the next guy comes in, he says, we'll triple your money. He gets the money. But of course, his activities are not founded on a solid foundation. We're not going to produce miracles. If you can compound your money at 10% a year, it's a great accomplishment. And most people should not expect to do that or do better than that. The S&P 500, the main stock index in the United States, has risen at about 10.5% since 1920. Now, since 1920, we've had 17 recessions, the Great Depression, several wars, including a world war. Now we've had a pandemic, many geopolitical problems, many economic problems. We've still compounded at 10.5% a year. And if you put $1 in the S&P in 1920 and you held it strongly, you never bought, you never sold, you know what you'd have today? 8,000. That's the magic of compound growth without interruption. So for most people, the answer is put your money in, understand what you're doing so that you can be steady, don't mess it up. And I think that there's a great American investor named Bill Miller who has one of the greatest records. And he said, I quote him as saying, it's time, not timing, that produces success. Just put your money in and let time pass.
So market timing is difficult. As you just mentioned, you always say to buy time, not timing. So in a situation like this, in terms of asset allocation, are there any assets or portfolios you're particularly focused on?
Well, if you're going to ignore my advice and not just hold steady and try to move money around to improve, then I think that we have to be aware that the period immediately ahead is more likely to be a worse than average period rather than a better than average period. There are a lot of uncertainties, and in particular, of course, most countries have high inflation today. The central banks are trying to rein in the economies, cool off the economies in order to control inflation, which means that they're raising interest rates and withdrawing money from the system. And historically, these actions have, for the most part, produced recessions. If you can do it without producing a recession, we call that a soft landing. Most of the time, the soft landing is not achieved. So we're looking at a period ahead where business will not be as easy as it used to be. We were in an easy money environment with low interest rates, and now we're in a tighter environment because the Fed has to cool off the economy, which means that it'll be more difficult for companies, and economic growth will be weaker. That's the goal. Just remember, the goal of the central bank right now is to slow the rate of growth, because it is from an overheated economy, a too strong economy, that we get inflation. You can't have inflation control in a raging economy. You put all this together, and you must say that the next year or two will be challenging. We're predominantly what's called credit investors. We invest in debt. Debt, bonds, loans, are a promised stream of payment, a contract. A company sells you a bond. What that means is you give them money, and they sign a contract that they will pay you such and such interest every 6 months, and at the end of X years, you get your money back. This is a dependable contract as long as the company is creditworthy, and we think that this is a very good asset class in this environment. A year ago, high-yield bonds, which is one of our main products, produced roughly 4% interest every year. Now it's 9%. That makes it very attractive. And when you combine a high level of promised return with the contractual nature of the return, it sounds pretty good to me. In the long run, stocks which do not have the benefit of a contract participate in the growth of the economy and are expected to do better than bonds in the long run. But for the period immediately ahead, credit, I think, is a good tool. And if we run into tough times, your credit, or we call it fixed income investments, will probably do better than your stocks in a tough environment. But I want to add one more thing, and I want to demonstrate how complicated this area is. I never talk about this to make it seem easy. I don't want to make it seem easy. We know that the economic outlook is worse than it was in the recent past. We also know that the market is down. So the question is, is the market down appropriately given the worse environment, or too much, or too little? And, we suspect that there are challenges ahead for the economy. But what if I told you the recession will probably take 5% off of GDP, but the market is priced as if it's going to decline, GDP is going to decline 15%. That is to say, stocks are too cheap. So most people think positive event, prices up. Negative event, prices down. But it's not just events and prices. There's something in between, which I've been alluding to, psychology. It's not just what the events are, but how people feel about those events that produce the change in price. So if the events are negative, but the psychology is too negative, one can argue that the prices will go up. Now, I'm not making that argument. I'm only showing how much vagueness there is in this process of assessing future direction. Having said that, I admit that the future year or two will be challenging. I don't think it's going to be so bad that people should get out today in the expectation that they'll avoid a big loss and get in lower later. But it's certainly possible that the markets can decline from here. But no sure thing.
After this interview was arranged, I looked into what Oaktree was buying. I saw that you hold a lot of energy companies. Their relative performance is good, right?
We have a lot of portfolios. We have strategies to do many different things. Each portfolio holds many things. We do not bet so heavily on something that we commit the whole portfolio to it. Having said that, yes, we have holdings in energy, and not disproportionate. I don't make these investments. I don't make any investments anymore. I provide leadership and general direction, and my colleagues make the individual investing decisions. Having said that, I think it's fair to say that in the last year, energy investments produced the best results. And we made a lot of money in energy. Our goal as investors is always the same, which is to buy the things that provide the best bargain in terms of the ratio of the possible reward to the risk involved. So we're always trying to make investments which produce what I call is an asymmetry. You have a high probability of making money and a low probability of losing money. Now, at Oaktree, we go further. We say, if something has a big chance of loss, but a huge chance of gain, we generally don't do that because we don't like to make investments where we could have big losses. What we try to find is things with a good upside, which is disproportionate to a downside risk, which exists but is modest. And that's what we found in energy. And why? Why were we able to get good deals in energy securities? Why did we make these investments? And the answer is that in recent years, the world developed an allergy to fossil fuel. And people who believe in social responsible investing said, you must take all the oil and gas and coal stocks and sell them. And this is called ESG, among other things. We believe very strongly in ESG. We believe in being responsible investors. We believe that the businessman has responsibilities other than just to make money. We believe in the responsibility to the planet and the people who live on it, as well as our employees and our fellow citizens. But I don't believe that the best thing we can do for the planet is sell all of our energy investments. Let's say we do. What does that accomplish for the planet? Somebody else buys them. They still exist. Nothing has changed fundamentally or ecologically. Mm-hmm. It's just a show of intention. Mm-hmm. Who buys them? People who don't care about social responsibility. So maybe they buy up these oil and gas companies and operate them in a less responsible manner. That doesn't help the planet. The point is, we're going to require oil and gas for a long time. Mm-hmm. The state of California has just made a decision that they're going to stop the sale of gasoline-powered cars
2035?
2035, mm-hmm. which means that even in California, which is the most ecological state, mm-hmm. we're going to be selling gasoline cars for 13 years, and those cars are going to last 20 years after that, which means we're going to need gasoline for the next 33 years. The key question is, who can produce it the cleanest? So rather than saying we're going to sell all of our energy stocks, we say we're going to buy the companies that are better performers, and we're going to buy the companies that are lesser performers and make them better, mm-hmm. if we can. And I personally think that this is a more responsible position than merely selling, which accomplishes nothing, in my opinion. So that's the way we feel about it. And so many people were negative on energy stocks that, for us, they became one of the areas where you could find the best bargains. And in this way, I believe that looking for bargains and good investment returns for the clients and being a responsible investor socially came together.
It's actually the same as my investment idea. We're in an era of energy transition. But paradoxically, that energy transition increases the short-term value of the traditional energy industry because, as you said, everyone will try to respond to a predetermined future. So major oil holders will likely try to raise the price. That's a common assumption. I personally invest in energy stocks and related investments too. For balance, I may hold solar, wind, or hydrogen assets as well. We call it the barbell strategy.
I think we have to be realistic and practical in making decisions for our portfolios and for the world. In recent years, prior to this one, people were saying that fossil fuel, oil, gas, coal, are bad. Don't do it. And a lot of people said, sell your oil stocks. And some people did sell. And by the way, a lot of countries said, we're not going to engage in oil and gas production. We're going to shut that down and we'll import it from other countries, like Russia. And so in this process, Europe, to be green, some countries reduced their energy production and became totally dependent on Russia. And energy dependence is one of the weapons that Russia is using against the West right now. So now people say, well, maybe we need oil and gas. Maybe it has to be produced. So I think that this idea that oil and gas are bad, you should sell stocks, you shouldn't engage in that industry, is simplistic. And the world is not simplistic. And I've been here with you now on this interview. What am I talking about? How complicated things are, how difficult things are. There are very few important decisions in life that can be made on the basis of one factor. You want to be green? Shut down your oil industry, and then people will be cold and won't be able to get to work. It's not so easy. people said arms manufacturers are bad. Shut down all the arms manufacturers. Sell the arms manufacturers. Guess what? We're at war. We've been attacked in Ukraine. Now we need arms to fight Russia. Maybe arms are not so bad. Again, a multivariate decision, not one.
You've emphasized risk management for a long time. And are there any particular risks that investors should avoid or manage at the moment?
This idea of risk management is very interesting. First of all, there's risk management, which means using statistical techniques to predict the downside of a portfolio. And I don't believe in that. And I don't believe that people can show me that it has worked. Risk management, I believe that after 01, 02, it was mandated that every bank have a risk manager. And more money was spent on risk management between 02 and 08 than in the rest of history put together. And guess what? We still had a global financial crisis. So I don't think you can eliminate risk through the application of statistical tools. And then you have risk management. Every investor at Oaktree, every investment professional at Oaktree is a risk manager, which is to say that when they pick up an opportunity, in addition to figuring out how well it will go if things go well, it's their job to figure out what would happen if things go poorly. What is the risk? To assess how much the downside is, what would have to happen for us to lose money, how bad it could get, how probable it is that it'll get that bad. And then the portfolio manager's job is to understand, if we add that security to the portfolio, what does that do to the overall risk? Things like correlation and so forth. But I believe that this function is best performed by analysts and portfolio managers, not by somebody who sits over there, who is neither an analyst nor a portfolio manager, but a very good statistician. And in Oaktree's investment philosophy, there are 6 tenets. The number one is risk control. And we believe that a successful long-term record is best produced by having a long series of successful investments and no terrible ones. Not by trying to shoot to the moon, but just try for consistent success and avoidance of disasters. And of course, we're now, I've been working with my clients my colleagues for 36 years. I've been a manager for 44 years. And I think this is the record we've produced. We don't do as well as the big risk takers in the good times, perhaps. We do much better than they do in the bad times, and we do steady throughout. And number 2 on our list of investment philosophy is consistency. I believe risk control and consistency can be a very satisfactory foundation for long-term investment success, and that's what we try to produce.
The interview is almost over. Actually, there's a question I really wanted to ask you. I think many Korean investors will be curious too. Even though you said Oaktree doesn't forecast the future and invest based on that, I have a question for you. There seems to be a consensus that the Federal Reserve played a significant role in the current instability of the global financial markets. But recently, there's been growing discussion in the US markets about a possible Fed pivot, where they might soon stop raising interest rates or even lower them. So I really want to ask you this. Has the Fed acted appropriately to rescue the US or global economy from this inflation? And if there is a pivot in the future, when do you think it will happen? I'm just asking casually.
The first thing I want to say is that if you offered me that job, I wouldn't take it. It's very challenging. Since I don't believe in economic forecasts, I would not know how to do that job. And in the last memo, which I believe you read, I talk about the fact that even the Fed can't predict what it's going to do. And this shows the challenge that's involved. Second, I believe that the Fed and all the world central banks had the challenge in 2020 of confronting something it had never seen before, which was the pandemic. And in a crisis, in trying to figure out what lies ahead, I read a quote from a Harvard epidemiologist named Michael Lipsitch. He said, we have facts, analogies to prior experience, and supposition, which means guesses. But in the pandemic, we had no facts. We had no prior experiences to generalize from. All we had was guesses. That was true for the doctors trying to respond to the pandemic. It was also true for the central bankers trying to respond to the economic difficulty. This is the first time in history that the economy was shut down to prevent the spread of a disease. First time. How do you figure out how to do that and how to recover from it? So the vaccine was developed, and I use the analogy that sometimes when a man is very sick, a person, they put him into a coma so that they can develop a cure and fix it. And then, of course, you have to bring the person back to life. They put the economy into a coma. They had to, A, keep it alive, and B, bring it back to life. How do you do that if you've never been through it before? So the Fed took very strong actions. March 23rd of 2020, I believe it was, they announced the stepping up their program. And by the way, the markets went straight up from
2020.
2020 from March 23rd, straight up.
Yeah.
Now, you have three choices, let's assume. You can do it exactly right, too much, or too little. Which should you do? They don't know how to do it exactly right since there's no precedent. Okay, take that one off the table.
That means too much.
Too much or too little?
Too much.
Too much. And they did too much. And in America, for example, I happen to know the statistics, in the third round of relief, they sent a check to everybody who made less than $175,000 a year, which I think is 80% of the population. Now, something like, I estimate that something between 10 and 20% of the population was hurt financially by the pandemic. So 10 to 20 were hurt, 80% got checks. 60 to 70% of the population got checks for nothing. And they couldn't spend the money because the economy was shut down. You couldn't go on a vacation, you couldn't have a wedding, you couldn't have a party, you didn't need a dress for a party. So people got rich. The money piled up in the bank. At the same time that manufacturing was shut down. So they did arguably too much, but they did not want to do too little and let the economy slide into a depression. I believe that if the central banks had not taken action, there would have been a global depression. And a global depression is not just a recession that's a little worse. It's horrible. My father and mother lived through the Depression, and believe me, they told me about it. And you had grown men standing on street corners selling apples because they couldn't get a job. So the central banks did too much, especially the Fed, and it laid the groundwork for inflation. What is inflation? Too much money chasing too few goods. So people had too much money, they were enriched by the relief, too few goods, the manufacturing was shut down, and when it started up again, it was a little unsteady. So we got inflation. Now, the big mistake was that the Fed concluded that it was likely to be transitory, temporary. I'm not smart enough to know whether that was well-reasoned or not. It was merely wrong. And as a consequence, they didn't start to reduce the stimulus early enough, and now we've had inflation now for a year and a half at a serious level. So now they're trying to withdraw stimulus, reducing interest rates, and rather than buying bonds, which puts money into the economy, they're selling bonds, which takes money out of the economy. And so you have to, before you criticize, you have to understand the difficulty. And anytime I think I know better than them, I say to myself, would you like that job? And that's why I said no. So they are now going to stay what we call hawkish. Easy money is called dovish. Tight money is called hawkish. They're going to stay hawkish for a good period of time. I would estimate at least till next summer. Number one, they want to stop inflation. And, you know, when we go camping, whether they tell you, if you have a campfire, it's not enough to put out the flames. You have to make sure that the embers are cold so that they won't start up again when you leave, right? They have to make sure all the fire is out. Number two, they have to slay the dragon of inflation. They have to kill inflationary thinking. Inflationary thinking is very dangerous because if I believe that there's going to be inflation ahead, I say, well, prices are going to go up in the future. I better buy now. What does that have? What does that do? It causes prices to go up. So inflationary expectations are self-fulfilling. They have to stamp those out and kill them. Kill them. And then number three, they have to preserve their own credibility by not do easy, hawkish, dovish, hawkish, dovish, hawkish, dovish. They have to appear to be presenting a consistent framework. So I think that they're going to stay hawkish for a good period of time, and that is likely to bring on a recession. Most people believe that the recession will be relatively brief and relatively mild. And what I say about that is we'll see.
Okay. Here's what's impressive, that the COVID-19 pandemic was something the world experienced for the first time. If the central bank had left it in a coma, so to speak, then they would have had to operate in a coma state, that they had to perform surgery. That surgery for inflation, surgery for a fatal disease, doesn't seem that easy, is what you're saying.
It's a very metaphorical expression.
What's more, the recession resulting from that operation might not be as mild or brief as we think. Anyway, you gave me the answer I was worried about. We'll leave the interpretation to ourselves. Finally, I want to ask you this question. Oaktree also has a Korean portfolio, right?
We don't have a Korean portfolio, but we include Korea in many of our activities. We have
Right.
we invest in emerging market equities, and that Korea is eligible for inclusion there. And we have owned the debt of Korean companies from time to time in the past.
Right.
And we make real estate investments in Korea.
Okay. Korea is an industrial country that has achieved unprecedented development. Perhaps it even skipped the middle income trap or broke through it very quickly. It's shown sufficient performance. Recently, there's been a lot of negative public opinion about the Korean economy. Since you've come to Korea, you must have thought a lot about Korea. So, for my final question, I'd like to hear your thoughts on the Korean economy. Based on that, if you have any advice for Korean investors, please share it with us.
I've been coming to Korea for up to 15 years. I enjoy my visits. I have friends here that I like to spend time with. I have a high opinion of Korea. I think it's a very industrious country, well organized. I think it has a good balance of prudence and, shall we say, aggressiveness, and good energy, high aspirations for the future. I stress the fact that I don't know enough about Korea to have an opinion on its markets. I think it has a bright future. I don't know how its securities are priced commensurate with that future. I certainly am happy if Korean securities are included in our portfolios, but I keep my hands off.
Okay.
All right. It was great honor to have you here, our studio, and I was so happy to share this privilege to our audience. Thank you very much, sir.
Well, it's great to be here.
Thank you
and
very much.
I look forward to the next time that I can see you, Jacob, and you, Nam,
Okay.
In New York.
In New York.
in New York, on Wall Street.
All right. Thank you very much,
good.
sir.
Thank you.
Thank you.
Harald, thank you.
The important thing is, then what? We all know what's going to happen over the next year. Information that everybody has is not helpful because we all have it. Investing is a matter of knowing something other people don't know.
Today is a really, really special day for me. I've been invited by Chairman Howard Marks of Oak Tree Capital to his New York office, and I'm pleased to share this interview today. For today's interview with Chairman Howard Marks, I've invited Mr. J. Young Yang as a co-interviewer, who has long worked in the New York bond market and with whom I have a long-standing relationship. I believe about the bond market, capital markets, and investment markets. We'll have a much more in-depth discussion. First, let me introduce Mr. J. Young Yang, who will be interviewing with me.
Hello everyone at Sampro TV. My name is Jay Young Yang. As Mr. Kim mentioned, I worked in US Treasury trading at HSBC for 6 to 7 years. Before that, I worked with subprime mortgages at Shear-Aegis. I've worked on Wall Street for nearly 20 years, and now I'm managing a bond fund in the Middle East. It's great to meet you all.
Thank you. Shall we introduce today's main guest? I'd like to introduce Chairman Howard Marks of Oak Tree Capital. Thank you so much for your time today, Chairman.
It's a pleasure to be with my Korean friends again. My trip to Seoul in November was very positive, and I'm glad to have a second opportunity to speak with you.
Since our valuable interview at our office last November, I want to convey that Korean people have been deeply impressed by your insights and perspective and are very grateful. Now, with Chairman Howard Marks, we'll ask several questions about recent major changes and hear his insights. A few months ago, Chairman, you mentioned sea change, which could be translated in Korean as a complete transformation. Describing such a big change, you said this was the first major change you've witnessed since entering the industry in 1959, after 2 previous changes. Since then, there have been substantial changes. Inflation has come down considerably, and there's talk about the Fed pivoting on rate hikes. Do you still maintain your view about the fundamental sea change that you wrote about in your memo?
Over the last 40 years, we've had virtually all the time until last year either declining interest rates or super low interest rates. 40 years. That means that you and I and Jacob and almost everybody who's watching have rarely seen anything else. And this has shaped people's expectations. They think that's normal. But interest rates went from, I had a loan outstanding from a bank in 1980 at 22%. And then in 2020, I was able to borrow at 2%. Interest rates came down by what we say 2,000 basis points.
Yeah.
The one thing I'm sure of is that's not going to happen again. Because when interest rates are 2, they can't come down much. In this period, the second sea change was the opening of investors' minds to things that, to the taking of risk, as long as the risk appeared to be justified and rewarded.
Yeah.
So a high degree of prudence, a high degree of safety, an insistence on risk avoidance, all of these things disappeared. And now we have a weighing of risk and return. This is the second sea change. The third sea change occurred, it began at the beginning of 2009, when the Fed took the Fed funds rate to 0 in order to stimulate the economy and fight the global financial crisis, and began quantitative easing, buying bonds, which puts liquidity into the economy. This worked very well, and the economy made a recovery. Over the 13 years, from the beginning of 2009 until the end of 21, we had again, declining or low interest rates, strong economy, no inflation, or insignificant inflation. This encouraged the Fed to continue lower. The slogan was lower for longer. And with the Fed able to keep interest rates low and yet not have inflation, we had a strong economy, easy for companies to make money, easy for companies to avoid default or bankruptcy, easy for companies to raise financing, even if they lost money, happy investors, eager buyers. Nobody was afraid. And it was just an easy environment to get everything done. And I would just say easier than normal. And so this can't go on forever. This is, what I'm talking about now is the groundwork for the third sea change. So much money was pumped in to fight the pandemic effect on the economy. We started to see inflation. That means that the Fed can no longer remain lower for longer. They had to raise interest rates in order to fight inflation, cool off the economy. And, you know, inflation is primarily too much money chasing too few goods. So they had to cool the economy so that the demand for goods would cool off. I believe that there is a realization that keeping interest rates super low forever is not healthy. You can't stimulate constantly stimulate. The economy has to operate naturally, organically. And, you know, at the end of 2020 or the beginning of 2021, there was a belief that the Fed would, by constantly stimulating, could engineer perpetual prosperity. But it always sounded too good to be true to me. And now I think it's turning out that it is too good to be true, because now we have inflation. And the inflation, which is very bad for many aspects of the economy, prevents the Fed from continuing to stimulate. Now, in the current years, I think we'll probably have a recession because of the big increase in interest rates. The Fed raised rates last year the fastest in history, from 0 to 4.5% in 9 months. So we'll have a recession. It'll be harder to make money. It'll be harder to avoid bankruptcy and default. Bankruptcy and default rates will return in the direction of normal. It'll be harder to raise money for your company. And now, investors or lenders or providers of capital, on the one hand, they want to put their money to work, but on the other hand, they're a little worried about the future. So it's more balanced now. So in many ways, I believe that the 13 years I'm talking about were unnatural and too easy. And in the coming years, it's going to be normal, which is a change. And, you know, if people came into our business 15 years ago, that's all they've ever seen. They think that's normal. It's not normal. That was the best of times. Now, I believe we're in more normal times. But we're not going to have 0 interest rates. We're going to have 2-3% interest rates, maybe 4.
Even 4.
And that will change everything.
While reading your sea change memo, I found something interesting you mentioned. In 1980, Howard had a loan with 22.25% interest, but in 2020, it was 2.25%. That's a 2,000 basis points or 20% decrease. You mentioned framing that 22.25% bill. So I wanted to ask, did you also frame the 2.25% bill from 2020?
It's not, but it should be.
Should be, right?
And I'll have to get a copy and print.
Talking about that 2.25% bill refers to when the base rate was nearly 0%, which might be a future we'll never see again. Since there were only 2 sea changes in 50 years, would it be correct to interpret that such changes won't occur for at least the next 20 to 25 years?
We may or may not see it at that low. But I think the important thing is that rates have come down. I don't think they're going back up. But they come down. They're going to be more steady. But not so low. You know that when the Fed took the Fed funds rate to 0 in 2009, it kept it there for 7 years. And that's too long. It's unhealthy. 0 rates is an emergency measure. We didn't have an emergency for 7 years. The economy was, let's say, doing fine by 2012, 2013, 2014. So 3, 4, 5 years. Why keep it at 0 for 7 years? And the market got used to 0 rates, which was unhealthy. It's like a child with candy. And sometimes you have to take the candy away. But they didn't do it. And so this period was distorted by rates that were too low. The coming years, which will not see the same level of stimulus, will not be as much fun. But the economy and investing is not about fun. It's about doing what's prudent in uncertain circumstances.
Let me explain the frame I have here now. When Howard received his loan interest bill in 1980, the interest rate was, as mentioned, 22.25%. Howard thought this will never happen again, and framed that bill, as you can see here. As someone who once worked in bonds, when I think about that time, it gives me chills. So I requested Howard to frame his 2.25% bill from 2020 in the same frame and show it in our next interview. He said he'll bring that frame when he comes to Korea for an interview in November. It's truly a frame worth celebrating, so I wanted to share it with all of you.
So in one of your memos, you said that because of the low inflation or low interest rate environment, the investors are walking on a moving walk and get a bit of a free ride on the moving walk. And with this sea change you're talking about, do you think we could be in the moment where the moving walk is actually coming backwards?
Not backwards, just stopping.
Stopping. Yes.
You see, in the memo, I give a list of the effects of low interest rates or declining interest rates. And among other things, number one, they make assets more valuable. If you own a company and it produces, 1 million won per year of profit, in a high interest rate environment, that's not such a good deal. But in a low interest rate environment, that's very desirable because it's hard to make that kind of money. So the value of that company rises. That's what happened in the 13 years. And companies, properties, shares, all rose in value. And the owners said, boy, I'm smart. But they didn't realize they were on a moving walkway. And by the way, if everybody's on the same moving walkway, then they all think that they're at equilibrium versus each other. The other thing is this. If you had a loan outstanding, the way I did, every year your interest rate came down. So any transaction that you financed with borrowed money became smarter. So what about people who had bought assets using borrowed money? They had success 2 ways. Asset prices went up, cost of capital went down.
Right.
Well, what if that's over? You see, this is the main thing. If the moving walkway is not going to produce this free ride anymore, then we have to ask ourselves whether the strategies that worked in that period are going to be the strategies for the coming period. And I think the answer is clearly not so much.
Moving to a different topic from Silicon Valley Bank's bankruptcy to the crisis of regional banks. Could this perhaps be part of the sea change Howard talked about? Should we view this as a sign of another major crisis, or is it, as Jamie Dimon suggested, almost over, or as Jerome Powell described, should we consider it just an inevitable event? I'd like to ask Howard what he thinks about this.
It's a good question. In the easy days that I describe, the 13 years, certain practices were encouraged. And in many cases, they were easy times practices. But when the times change and things become hard, maybe they don't work so well. So in easy times, when risk does not come home to hurt you, the person who takes the most risk makes the most money. And risk-taking is encouraged and continues and increases. As Warren Buffett says, when the tide goes out, we find out who was swimming without a bathing suit. And so when the conditions become normal or challenging, then the person who took the most risk has a problem. And that's much of what we saw. In thinking about our portfolios from the macro, I usually think about aggressiveness and defensiveness. This, to me, this is the main axis on which we have to decide.
Right.
So for you or for me or for Jay, there's a right amount of risk. There's a position on this line that's right for me. I don't have to save for my old age anymore. and I have plenty of money stored up. So I can afford to be aggressive. I can take a chance. Somebody else has to be more conservative because they have to ensure their future. So that's, we select our normal position. Then we say, what about today? Today, should I be more aggressive than usual or more defensive than usual? Well, the point is, nothing works all the time. Aggressive behavior makes you more money in the good times, but loses you money in the bad times. Conservative protects you in the bad times, but you have to look at others in the good times making more, which is challenging, produces envy. So the point is that the people who engaged in aggressive behavior in the good times had it perfect. But if they continue with that behavior when the times become more difficult, then they get into trouble. And there's an old saying in the lending business that the worst of loans are made in the best of times. So when things are going well and risk-taking is successful and there are no troublesome events, people become more and more aggressive and they relax their standards and they lend more money to weaker borrowers with less protection. And then when the cycle turns down, those are the ones that get into trouble. And so some of the banks that failed grew super fast, and some of them, like Silicon Valley Bank, were in an area concentrated. You know, these are regional banks. So the SVB concentrated on a region that was engaged in an aggressive activity of venture capital, which boomed in the good times, busted in the bad times. And that contributed, that was not the whole problem, but that contributed to its demise. So you're absolutely right. The change in the environment is very, very important, and it should not be overlooked.
Right.
As you may know, Jacob and Jay, when I was in college, I minored in Asian studies. And it brought me into contact with Asian philosophy. And I think one of the things I learned from that is the importance of attributing power to your environment. It's not how smart you are or how strong you are, but also your environment will determine a lot of what happens to you. And you don't necessarily have control over that or the ability to predict it. And you have to understand your environment and react appropriately. And I think that's what all of this is about.
That's truly moving. It seems the message was understand the environment well. Perhaps the mention of sea change means that if we understand significant environmental changes well, even without being extremely smart or strong, we can survive and perform well and build a great company like this. It seems that's the wisdom you're sharing with us.
I think that people tend to overestimate what's under their control. And our business, which means dealing with the unknown future, is much, much better if we understand our limitations and prepare for an unknown world rather than assume that we're in control and it will go as we expect.
And you kept saying that we don't necessarily know what's ahead of us, but more importantly is that we know that where we are now. So our next question is, it's related to your most classic investment book, The Most Important Thing. In that, you mentioned about the importance of second level thinking. And that is to say, in order to generate superior returns, you need to start thinking another level. So if you think about the broader equity market today, what are some of the things that second order thinkings or second order questions you are asking, and how does that translate to the second level of where the equity market is today?
It's really pretty easy, Jay. Everybody knows inflation is up. Everybody knows that the Fed has had to raise rates to fight the inflation. Everybody knows this will bring down the economy, slow it down. Probably have a recession, not too bad, we'll come out. I think everybody agrees on that. Some people think the Fed will pivot to dovish behavior, that is, reducing interest rates this year. Some people think next year. Not a very important distinction. But let's say that everybody agrees on the things I mentioned. That's not the important thing. The important thing is, then what? We all know what's going to happen over the next year. Information that everybody has is not helpful because we all have it. Investing is a matter of knowing something other people don't know. So this idea of what the next year holds is not very helpful. Nobody has taken issue with the basics of sea change, but nobody has said, oh yes, I agree, it's going to stay that way for 5 or 10 years. That's the important thing. If it's true that over the next 5 or 10 years, we're not going to have interest rates that are declining or ultra low, that's the important thing. And that means that the economy will not be as stimulated. Defaults and bankruptcy will be higher. Importantly, today, because interest rates are higher, an investor can get very good equity-type returns by investing in debt where your return is contractual. You're not depending on the market. You come from the fixed income world, so you lend out some money, the borrower promises you interest, and then he pays you back. And your return is a certainty as long as he pays you. If he doesn't pay you, you get his company. So he has a lot of incentive to pay you. Well, if you can get a high return on that basis, that's very attractive. And that means to me that to take the return, the risks that are associated with equities is not as important. And so I think that most investors, depending on their circumstances and their aspirations and their tax situation, most investors should have more debt in their portfolios today than they did 3, 6, 9 years ago. That's the biggest change for me. I wrote a memo called What Really Matters in November. And the main thing I was arguing against was this fixation on the short term. You know, how fast will inflation come down? How much will the Fed raise rates? Will that produce a recession? How bad a recession? How long will it last? These are not the important things. Your viewers running their portfolios should be concerned about 5, 10, 20 years, not 1 year. And so they have to think about things that are more long-lived than just the ups and downs of inflation, recession, and rates.
Regarding the sea change memo and what you just mentioned, I was reminded of something I had forgotten. Howard said when he first entered the industry, the most popular stocks were the Nifty 50 stocks. Back then, you were considered foolish not to buy these stocks, and people expected their prices would rise forever. Surprisingly, he mentioned that if you had held Nifty 50 stocks until 1974, you would have suffered a 90% investment loss. Even today, we see people getting excited about concentrated investments in certain sectors or assets while ignoring stocks with real value. Despite investment gurus like Howard continuing to advise, don't follow the crowd, always think contrarian, people don't change. So I'd like to ask Howard again, as an investment guru and senior mentor, to advise investors on how they should manage their mentality. I would appreciate if you could emphasize that point once again for us.
It's only natural that the stocks of better companies should be more expensive. Which are the better companies? That's the question, you know? In the Nifty 50, there were two beliefs, Jay. One was that these were companies that were so good that nothing bad could ever happen. And two, these are companies that were so good that for their stocks, there was no price too high. So people were not applying value discipline. They were worshiping at the altar of these companies. Now it happens, first of all, that at least half the companies ran into serious trouble. So this idea that nothing bad could ever happen was a big mistake. And I would say in many cases, among other things, there was a failure of second-level thinking. For example, one of the leading companies of the Nifty 50 was Xerox. And Xerox, at that time, had a monopoly position in dry copying without liquids. But not enough people said, hey, wait a minute. They have a monopoly. They're keeping the prices very high. That produces exceptional profits. But mightn't those profits attract competitors who would then require the prices to decline? They'll compete on price. How will Xerox do if it has to compete on price? And in fact, mostly Japanese copier companies developed competing products. I think Xerox either went bankrupt or got very close. Everybody knew Xerox was a great company. The question is, who asked, yeah, but is it sustainable? So that was number one. And then number two, this idea that there was no price too high for these stocks. I mean, I was lucky because I was a boy at the time, literally a boy. And I learned an important lesson in the 70s, which is that there are no assets which are so good that there's no price too high. For every asset, regardless of how good it is, there's such a thing as a bargain price, fair price, overprice. That's the realization that nobody had at the time. But some people said, yes, it's a great company, but it's not that great. You see, And this is the greatest example of second level thinking. The first level thinker says, it's a great company, you should buy the stock. It's simplistic, everybody understands that. Probably wrong. The second level thinker says, it's a great company, but it's not as great as everybody thinks. So as a result, it's overpriced, you should sell the stock. You see, you have to, that's a very simplistic example. But the point is you have to take your thinking to a higher level, more in-depth, more nuanced, asking more questions, not so superficial. And I'm very lucky to have learned this lesson at a very young age. By the way, you only learn from difficulty. Very few valuable lessons are learned through success.
Since you entered the industry in '69, it's been 54 years. I'd like to ask if you've been happy doing business and investing for 54 years, and what has been your driving force to consistently invest while sharing wisdom through memos for others?
When I was young and learning, people shared their wisdom with me. I can only do the same. I have to, we say, pay it forward. Pay it forward. Pay it forward. I'm just very happy to share my ideas. The ideas themselves are not the key to success. The key to success is good implementation. So I'm not worried that I'm going to give away my livelihood. But it just seems, if you read all the great mathematicians, philosophers, historians, aestheticians, everybody, they have an idea, they wrote it down, they shared it with the world. And I hope my ideas are worth sharing. I started off sending the memos to my clients. I thought they should have the benefit of my thinking. And of course it's bigger than that now. But still, I want to leave this world a better place. Now, I'm not able to be a statesman or a nuclear physicist or a polar explorer. I work in a small world. But, you know, I get a lot of letters from people who say, you changed my life. You helped me go in a new direction. To me, that is so gratifying that you know, that's what I did with my life. Hopefully, along with being a good husband, parent, grandfather, friend, community member. But the thought that you could make other people's lives better through your intellectual process is it's all you need.
In my opinion, Howard has done more meaningful work than any politician, nuclear physicist, or polar explorer for ordinary people, especially investors, I think so. Last week, I went to Nebraska, Omaha, and saw Warren Buffett and Charlie Munger from afar at the Berkshire Hathaway shareholders meeting. As you know, Charlie Munger will turn 100 next year, and Warren Buffett is already in his 90s. Personally, I hope Howard will continue sharing wisdom with our investors even longer than them, and I wish you good health. So finally, I'd like to ask, how long do you plan to continue investing and sharing your insights through these memos?
I'll do it as long as I can. You know, it's extremely rewarding in my life, and it's so satisfying when you push through to an idea, to a thought you never had before. It's just the greatest thing, and this is what makes the profession of investing very interesting. And you know, I'd like to do it forever. I just spoke to Charlie yesterday, and you know, he's enjoying his life. Maybe I should have set a goal of 99. But my own father lived to 101, so maybe that should be my goal. But Warren Buffett, he talks about the fact that he skips to work in the morning, and I don't know if I can skip anymore. I don't know if he can skip, but the excitement of of dealing with ideas keeps us excited about going to work. And when I lose that, I think I'll lose a lot. I look forward to interviewing with you both in 20 years.
Please.
We would love to.
Please.
Very good.
Thank you very much. We're grateful for your humor and encouragement. And as mentioned, we sincerely hope you'll continue to work with us investors for a long time, and we look forward to another interview at our office in Seoul this November.
Thank you.
In Howard Marks' office at Oaktree, we've conducted an hour-long interview. It was truly a moving interview. I'd also like to thank Mr. Jae Young Yang for co-interviewing.
Thank you very much.
Thank you.
Thank you very much.
Thank you to all our viewers who watched until now. Thank you.
Thank you.
You can't cuddle up with your money. It's not going to keep you warm at night. Money is just a scorecard. You know, when you get to the point where you have more than you need, the rest is just a scorecard. My first book was called The Most Important Thing. It's not money. I love to invest. I'm 77 years old. I'm still going to work and part of our organization. I would say at this point not to make more money, but it keeps me thinking, it keeps me active. The most important thing in the world is having loving connections with friends and family, in my opinion. Well, I'm glad to say hello today and to have you with me. And Jacob and I have been working on these videos for a couple of years, and they're most enjoyable. Glad to be here again. Well, a sea change is a change which is fundamental, significant, and probably long-lasting. I've been in this business 54 years. I've lived through 2 prior sea changes. This is, I believe, the third. The first was 1978, when people revised their thought process. Before that, they looked for high-quality assets. After that, they said, no, we'll buy low quality if it's cheap enough to compensate for the risk. That was a change. And that change has considered to today. Today, nobody says, no, it's low quality, we won't buy it. Today, they say, it's risky, but it offers a high enough return to compensate, so we'll do it. The second change was the retreat of interest rates starting in 1980, when interest rates turned down. And that set off this 40-year decline in interest rates, which has made a lot of money for asset owners and for borrowers, and especially for people who own assets with borrowed money. This was the perfect environment for that kind of operation. The essence of the sea change memo is that it's over. So what the memo said, what the third sea change is about, is that anybody who came into this business or entered into investing since 1980, 43 years, has only seen declining interest rates or ultra-low interest rates. And what people do is when they see something for a period of years, they tend to think that that's normal, and it'll always stay that way. But I believe that's not true in this case. I believe that the period of ultra-low interest rates is over, and that has very significant repercussions for which investments will do well and which will do poorly. Sir John Templeton, who was a great investor in the last century, maybe the 1980s, said that that people tend to say this time it's different, as you say, to rationalize unusual valuations, and that gets them into a lot of trouble. But he also said that 20% of the time, things really are different. And I believe that this is one of the times when it really is different. And clearly, with the Fed funds rate now at 5%, there's not that much room left for a decline. And I think there are conditions in place which will cause the Fed to maintain interest rates in the vicinity of where they are.
Right.
One of these days, the Fed will declare victory against inflation, and it will be able to lower interest rates a little bit to stimulate the economy. But I think, I make a statement in the memo that in the 5 or 10 years ahead, the Fed funds rate is more likely to be between 2 and 4 than between 0 and 2. So that's a bold statement for me because I don't believe in forecasts. But I think that interest rates were ultra low in the period I discuss in the memo, 09 through 21, and I think that they're not going to be that low in the period going forward. The environment has a profound effect on what works and what doesn't. And for the 40 years, and especially for the 13 years from 09 through the end of 21, investors received a tailwind, help from the declining rates. Declining rates stimulate the economy, increase consumer demand, drive business to companies, make companies more profitable, make assets more valuable, reduce the cost of capital, make financing readily available to companies and cheap, and make it easy to avoid bankruptcy and default. In other words, an easy period. It was very easy to succeed. And this was very good for asset owners and borrowers. And of course, great for somebody who owned assets with borrowed money. And if you accept that that's over, that we're not going to be in a period of declining and ultra low interest rates in the next 5 to 10 years, then other strategies will be the preferred ones. So, I mean, the first question is, do you agree with my thesis about interest rates? Each person has to make that decision for themselves. But if it's true that we have this change, then people have to say, well, what are the strategies that will do well in the new environment? And for the 09 to 21 period, interest rates were extremely low, the lowest probably in history. The Fed funds rate averaged 0.5%, which is extremely low, unnaturally low. So investing in debt securities, which is most of what Oaktree does, was not rewarding. A year and 3/4 ago, high-yield bonds yielded 4%. Not very desirable. Today they yield more than 9%. So that's a big change. And all along the spectrum of debt, or what we call credit, the available yields are much more satisfactory today than they were in that period. And the impact of the sea change is that I think people should consider investing in debt securities. Today, investors can get equity-type returns from debt, and debt, which consists of a promise to pay, is much more dependable than equities, which have no promise. The S&P 500 index returned about 10% a year on average for the last century. That was enough to turn $1 into $14,000. And today, debt securities offer, as I said, high-yield bonds in the 9s, private debt, hard for the individual to access, in double digits.
Double digit.
So that means equity-type returns. And that's a wonderful thing that has been missing for a long time. And, I'm thrilled to see that it has returned. Stocks are great. Stocks permit investors to participate in the growth of the economy and the success of leading companies. And I'm not saying that your subscribers should sell all their stocks, but maybe part and move into debt instruments at this time. I think that a balanced portfolio is attractive today, whereas in the period that I'm talking about, an investment in debt instruments would not have been very helpful. Well, first of all, let me clarify for your subscribers that we don't really have high interest rates today. We have normal interest rates. The rate was abnormally low for that period, 09 through 21. You know, the great American economist Paul Samuelson, who wrote the economic textbook that that I used when I was a student, most do, said, "When events change, I change my mind. What do you do?" And you know, when the environment changes, we must assume that a new approach is needed. Einstein says the definition of insanity is doing the same thing over and over and expecting a different outcome. I believe that another definition of insanity is doing the same thing in a different environment and expecting the same outcome. So equities and levered investments, investments made with borrowed money, worked extremely well in the period of declining rates. They clearly should not be expected to work as well with steady rates and with higher rates. People buying assets in that period were able to borrow money very cheaply and substitute the borrowed money for their own money to amp up the returns on their investments. We call that leverage. The key is the cheapness of the borrowed money. And if the borrowed money is not available as cheaply now or in the future, then leverage strategies will not be as successful. That's like math. It's logic. There's no supposition in that. And so I mentioned the effects of the favorable effects of declining interest rates. What about stable and normal interest rates? Well, I think that economic growth will be slower, business will be slower, company profits will be less, profit margins may be under pressure, assets will not appreciate as dependably, cost of capital will not be so low, and it will not be so easy to avoid bankruptcy and default. So, in other words, we went through an easy period, and I believe we're going into a harder period, not catastrophic. I'm not talking about a depression. I'm not trying to worry anybody, but life will not be as easy. And so investments like equities and leveraged, private equity is a great example of a leveraged strategy. These may still do okay, but they should not be expected to do as well. Debt, which was unsatisfactory in that period because the yields were so low, will be much more satisfactory in the coming period. You know, if you buy a high yield bond that pays 9%, you have a promise of payment. If the company keeps its promise, which the overwhelming percentage of companies do, you'll make 9%. There's no doubt about it. And that's a wonderful thing. So I think that now debt securities can play a useful part in most people's portfolios, whereas in the 09 to 21 period, they could not. Well, look, I was very fortunate, as you know. I was asked by Citibank to start their high-yield bond activities in 1978. And 1978 was the beginning of the high yield bond world. Now, most of your subscribers were born since 1978, so they may think that there always have been high yield bonds, but they're new, only 45 years old. We have always had bankruptcies and defaults. It's part of life. It happens that in the easy money environment of the last 13 years, the default rate was unusually depressed because the environment was unusually easy. In the new world, bankruptcies and defaults will occur again. By the way, over the last 45 years, on average, 4% of all high-yield bonds defaulted on average each year. But we get paid enough extra interest to make those risky investments that the investments were still satisfactory. So the mere fact that there are defaults and bankruptcies does not disqualify this as an attractive area for investment. I use the analogy to life insurance. How can life insurance companies insure people when they know they're all going to die? And the answer is, it's a risk they're aware of. It's a risk they can analyze. It's a risk they can diversify, and it's a risk that they're highly paid to take. So those four things, in my opinion, are the criteria for the intelligent bearing of risk for profit. And that's what we want to do. As an investor, I have no interest in avoiding all risk. If you avoid risk, you probably avoid return. What I want to do is take risk intelligently, where I'm well paid to do so. And that's the history of high yield bond investing. And we've been doing it for 45 years. We've lived through a period when defaults averaged 4% a year, and we've been very successful. By the way, in that period, there were 5 years when the default rate was 10 or more. 1990, 91, 01, 02, 09. And yet, we were still successful. Those years may have been a little painful, but over the entire period, investing in high yield bonds has been very successful. I think one of the most important lessons is that you have to, that investing is not a mechanical activity where the performance of the economy and the performance of the company translates directly into the performance of securities. Most people think that if the company does well, the security will do well. If the company does poorly, the security will do poorly. But they miss the fact that there's a step in between, and that is investor reaction. How do people feel about the progress of the economy and the company? You see, so for example, you can have an announcement of an earnings increase and the stock goes down. Why? Because people are disappointed. The earnings were up 10%. They thought it was going to be up 20. So they feel that the company is underperforming, stock goes down. So that's an important lesson, the role of psychology. And the ramification is that you must be conscious of the environment, psychological environment, when you are an investor. So I said in one memo that in real life, things fluctuate between pretty good and not so hot. But in investors' minds, they go from flawless to hopeless. And the swing of the pendulum is highly exaggerated. So when the pendulum swings positively and everybody feels good and is thrilled about what's going on and is optimistic about the future and excited, usually security prices go too high and become dangerous. And if you can detect that, you might want to reduce your investments or move to safer investments. Then eventually the pendulum swings, and now people are too depressed and too panicky and too pessimistic. And they think that we're going to have bad times forever. And when that happens, usually the prices of investments collapse. That's a great time to buy. So in the short run, psychology is more important than company fundamentals. And it's not correct to say good events are coming buy, bad events are coming sell. Rather, market is too optimistic, sell. Market is too pessimistic, buy. What matters is not the quality of the thing you're investing in, but whether the price is high or low relative to the intrinsic value. And it's from the fluctuations of price around the intrinsic value that dictates the performance in the short term. Now, if you're a real long-term investor, and if you're 25 years old, and you say, I'm going to hold this for 40 or 50 years, which is the right attitude in many cases, then you can ignore psychology swings. Because in the long run, if you hold your investments, your return will really be dependent on the fundamental behavior of the company. Ben Graham, who was Warren Buffett's teacher, said that in the long run, the market is a weighing machine, and in the short run, it's a voting machine. In the short run, the movement of price is determined by movements of popularity. In the long run, movements of price are dependent on the performance of economies and companies, what we call fundamentals. So every investor has to figure out whether they're going to be short-term oriented and buy, sell, or long-term oriented and mostly hold. Of course, you can be somewhere in between. You can not trade every day, which I argue terribly against, but you can make occasional changes in your portfolio when warranted, as I believe they are now. A friend of mine wrote a book about investing. The title is Simple but Not Easy. The things we want to do are simple to describe. The investor wants to hold more of the things that will do well and less of the things that will do poorly. Very simple. Executing is not easy. It takes skill to know what will do well and what will do poorly. And nobody should confuse themselves. And when I speak to you and to my other close associates, I always stress, I don't want to make investing seem easy. I want people to understand how hard it is so that they don't try anything too adventurous. I published a memo this summer called Taking the Temperature. And I talked about 5 market decisions that I made starting in 2000. And all 5 were correct. Sometimes it took a little while for them to be correct, but eventually they were all correct. And I describe how I did it. And I did it not based on data, but based on my sense for the environment. By the way, for example, Oaktree and I turned negative in 05-06 because we were worried that the market was behaving in a rash manner, taking too many risks. And that when other people take risks, it makes the world a risky place for me. Now, shortly later, we had the global financial crisis, which was a problem with subprime mortgages and mortgage-backed securities. And you know that Merrill Lynch, Bear Stearns, Lehman Brothers all disappeared. It was the worst environment I've ever seen. We managed to largely avoid it. Why? We didn't know anything about subprime mortgages, but we knew that the world was a risky place. So that's why I say take the temperature of the environment, but not easy. At that time, I had been working for 40 years. I had a lot of experience, so I could recognize what was going on in the environment. Somebody with less experience really did not have the ability to do that. So, look, investing is a great thing. Over a long period of time, investing will turn a little bit of money into a lot of money if you don't screw it up. But nobody should think that frequent, correct market timing is easy.
So the investment's not that easy.
It's not easy, but it's still very important. One of the implications is that most people should get help. Most people should not pick their own stocks or decide their own market timing. Most people should buy managed funds or index funds. Managed funds actively select investments, buy this, sell that, trying to have more of the things that do well and less of the things that do poorly. Index funds are passive. They just hold a diversified basket throughout without buying and selling. Either of those is better for the average investor than trying to do it yourself. Most people don't do their own legal work. They don't do their own medical work or their own dental work. Most people don't even fix their own cars. And yet, so many people think that they can do their own investing. What the individual can do is put aside money, set a course, and hold to it. But in most cases, the individual selection is better left to a professional. First, the investor has to say to himself or herself, what will be my approach to investing? Will you could establish a portfolio today and leave it alone for 50 years. And you will benefit from the long-term performance of the economy, the corporations, and the market. Or you can be activist and try to make frequent changes in your allocation. So I can't say what all your subscribers should do. It's an individual decision. They have to decide on the basis of their own expertise, how much time they want to devote to the process of investing, how much risk they want to take, whether they have dependents, whether they have enough money that they could stand to see decline for a while, because declines are part of life in the investment world. And what is their attitude toward risk? How strong is their stomach for living with fluctuations? Different for everybody. So I think that for the non-professional investor, the most important thing is invest for the long term. Don't be too active, because, our psyches try to get us to make mistakes. They try to get us excited when things go well and buy at high prices. They try to make us depressed when things go badly and sell at low prices, which of course is the opposite of what one should do. But it's common. That's why we have highs and lows in the market, because psychology becomes too favorable and then too negative. The key is to power through for the long term, not succumb to the short term, and not try to outthink the short term, because most people can't do it. So, as I say, save money. Don't spend all you make. That's the most important single thing. Put it aside, invest for the long term. Don't succumb to psychological excesses. Once in a while, you might try to make a change in your allocation when it is demanded. I think today is such a time. Anybody who has a portfolio of all stocks for the last 10 or 20 years did very well. I think that all stocks is not the right portfolio for the next 10 years. for the next 10 years, they should have a balanced portfolio with stocks, but also a large component of debt or credit. I think that's the right thing for the new environment. Mm-hmm. Exactly how large that component should be is different for everybody. Mm-hmm. Well, you have summarized the debate. Mm-hmm. Nobody knows the answer. All we have is opinions. Mm-hmm. Earlier in our conversation, you said that Oaktree and I are value investors. Mm-hmm. What does a value investor do? A value investor in, let's say, stocks, considers himself or herself to be an owner of the company. Mm-hmm. These are not pieces of paper that we trade to make money. Mm-hmm. These are ownership shares that we want to hold in the long run because we think we want to be part of that company. Mm-hmm. The value investor tries to figure out what the profits and cash flows of the companies will be in the coming years and tries to turn those estimates of cash flows into an intrinsic value today, and then looks to see if the stock can be bought at a reasonable price relative to the intrinsic value. Growth investors actually do something similar, but their time horizon is longer. Mm-hmm. They invest more on long-term trends, but of course when you think about the long-term future, you can't have a high degree of correctness, and you have to have what we would call a hunch about whether a certain technology or product will do well 30 years from now. But these forms of investing are based on analysis and projection of the future. Bitcoin or other cryptos, there's no such thing. There are no cash flows with Bitcoin. It's not a productive company that will throw off cash in the future. It may serve a purpose in the financial system of the future. That may or may not make it more valuable than it is today, and there's no place to look for the answers. So I believe that it's contradictory to say I'm a value investor in crypto, because you can't try to figure out the value of crypto. It has no backing, it has no assets behind it, and it has no cash flows. So that leaves us with the other term you used, speculation. Mm-hmm. Now, usually the term speculation is used to describe an unwise investment. Mm-hmm. I'm not saying that crypto is necessarily unwise, but what I'm saying is that speculative investment is the opposite of analytical investment. And as I mentioned, I think there's no such thing as analyzing the future of Bitcoin or crypto. We don't know, and you can't know. So it's all just a matter of opinion. And if you have a positive opinion, you can buy it. And if your positive opinion turns out to be correct, you may make a lot of money. And if it turns out to be incorrect, you may lose all your money. Mm-hmm. Because crypto could turn out to be valueless. So, speculation, betting on the future without analytical foundation. But I can't tell you that it's unwise or not to do it. In 2017, I wrote in one memo that I thought that that crypto had nothing behind it, and was speculative and unwise. I still think that's true. But Bitcoin was $10,000. Today it's $35,000. This year, it's probably the best performing asset.
Right, double up.
Yes. So my son, who is more open-minded and less constrained by old age than me, he says, "Dad, it's been around since 2008.
His performance is better than you.
His is better.
This year.
That's right. But it's been around for 15 years. If it was a scam, or if it was an empty promise, wouldn't that have been exposed by now? And the answer is yes, that's a good argument. Right. And in 2020, it went from 4,000 to 75,000. And then in the next year, it came way down, and it fell to 17,000, from 75,000 to 17,000. But this year, it's gone from 17,000 to 35,000. We all have our opinions, and we're entitled to our opinions. The key question for any investor is how much money are you going to bet on your opinion? And clearly, the story has not been written with regard to crypto. I will say that the fundamental argument in terms of crypto was what we call a use case. That is to say, there are uses for crypto, and people will start doing business in crypto and banking on the blockchain, where they don't trust the banks or the government, or they don't want other people to know how much money they have, or where they want to make transfers of cash in civilizations where it's hard to send money. I think it's fair to say that the use case has not been validated yet. And crypto's 15 years old, but I don't think many people are doing business in crypto yet. So all we can say is that the use case has not been proved out. It remains a speculation, but I wouldn't bet my life that it will end up being a bad investment. Well, clearly, I know a lot of people who are very rich and spend all their time trying to get richer. And some of them have poor relationships with their family members, and not many friends, and not many other interests. And all they try to do is get richer, and some get richer. For me, I mean, each person has to decide what's right for them. But for me, that's not enough. And when you get to be my age, and you say, am I happy with the way I lived my life? Am I happy with where I am today? You can't cuddle up with your money. It's not going to keep you warm at night. And money is, it's just a scorecard. When you get to the point where you have more than you need, the rest is just a scorecard. And it shows whether you were a smart business person or not. But being a smart business person is not the most important thing in the world. The most important thing in the world is having loving connections with friends and family, in my opinion. And also, Jacob, other interests. We talked before about golf, not my interest, tennis, which I love, and art collecting and travel. These are important too. You should have a well-rounded life. If your goal is to be the richest person in the world, then you're probably going to be unsuccessful because there's only one. Investing is fun when it's successful. It's not too much fun when it's unsuccessful. And if you invest well, you'll pile up more money. It's just that it's not the only thing in the world. My first book was called The Most Important Thing. It's not money. I love to invest. I'm 77 years old. I'm still going to work and part of our organization. I would say at this point not to make more money, but it keeps me thinking, it keeps me active. There's nothing more rewarding in life than tackling an intellectual challenge and being successful, and thinking things out, and understanding things better than others, and reaching answers that are correct. All these things are very rewarding, and they don't have to have anything to do with money.
Thank you very much.
Thank you.
Thank you.
Okay. Bye-bye.
There's a rule that there's a recession every 8 or 10 years. If you don't count that as a normal recession, we're in the 15th year or the 16th year.
Right.
We're due for one tomorrow. I'm pretty sure there's not going to be one tomorrow. I would say, my approach is to say, I don't know. I can't tell you. But when I look around in the environment, I don't see terrible excesses in the economy. I don't see
that consumption is overly enthusiastic. I don't see that inventories are building up too high. I don't see a large number of construction cranes in the sky suggesting overbuilding. It tells me things are kind of in the middle ground.
Yeah.
And in the middle ground, there's no stellar conclusion to draw. There's nothing you can say about the condition of our economy strongly, which has a high probability of being right. So I say nothing.
Got it. To all the viewers from the United States, Korea, and around the world, welcome to Global Money Talk by Sampro TV. I'm your host, Dan Ha. Today we're at the New York offices of Oak Tree Capital Management for a very special conversation with Howard Marks. Howard really needs no introduction, but for those who don't know, I will say that Howard is someone that Warren Buffett pays attention to. Howard has influenced and inspired generations of investors, including me. It is my great honor and privilege to bring you this conversation with Howard Marks. Howard, thank you.
Thank you, Dan. Thanks for that nice introduction.
Very welcome. So I'd like to start with one of your recent memos, Mr. Market Miscalculates. In it, you wrote about how in the markets, meaningless statements are often given weight, and how a given development can be interpreted positively or negatively depending on the prevailing mood of the market, which reminded me of an Amos Tversky quote, "People accept any explanation as long as it fits the facts." That said, price behavior can be a useful source of information at times. So could you please give a user's manual, if you will, on how to use price behavior as a source of information?
Sure, Dan. That's a complex question, of course. And I think the basic rule in the investment world is that there are no easy answers.
Sure.
I think what you say is very important, quoting Tversky. People always say, well, why did that happen? And sometimes the answer is no good reason.
Right.
There's randomness, there's irrationality. People say, well, he was a good man, why did he die? Well, there may not be a correlation.
Sure.
It's a good company, why did the stock go down? Well, who knows? Sometimes who knows is the right answer. But people, not just in the investment world, but in general, don't like going through life with the answer who knows. So as you say, or as Tversky says, they seek an explanation. Make sense of it. Well, sometimes you can't.
Sure.
I wrote a memo, and I'll say that a lot in the course of this interview, because I've written for 35 years, so I've written now on almost every topic in investing. A memo called "What Does the Market Know?" My general conclusion is the market doesn't know anything.
Okay.
The market is not some genius with a high IQ. The market is just the collection of the votes cast by all the people in it. So by definition, it's not any smarter.
Sure.
If you get a million people of average intelligence together, their conclusion is not any smarter than average. It's not like it accumulates to a greater total. Now, having said that, as you say, sometimes price movements are meaningful.
Sure.
So I think the answer is you can use it as a signal to think about things, a signal to do some research. You see a stock is way up or way down. You might try to figure out if there's an obvious reason, and try to figure out if the reaction of the stock price to the reason is excessive or insufficient. Maybe that will tell you there's something worth doing. But I have to stress, and I'll stress frequently in this conversation with you, that reaching these conclusions requires a very high level of expertise and experience and knowledge that most people don't have. So for the average person to look at a stock and it's up 20% this week, and to say, why is it up? Is 20% an overreaction or an underreaction? Will it go up more? And should I buy? The vast majority of people aren't equipped to make that decision.
Right.
And if they try to do so, they're really deluding themselves.
Understood. Also in that note, you wrote about how there are no immutable rules in investing that can be relied upon to produce the same results always. Right. Yet investors do tend to make rules based on their experience, mostly to protect themselves from repeating the same mistake.
Right.
Never let your largest position become X% of the portfolio or be greater. Well, next time when the XYZ are true, buy the stock.
Right.
Rules aren't perfect, but they can help an investor stay disciplined.
Yes.
What are some of your rules that you'd like to share?
Well, I think there's an old saying that rules are made to be broken.
Okay.
You can have general policies.
Okay.
But I think it's important to be ready to break them as necessary. I mean, a great example is some people adopt a rule that if you buy a stock, if it goes down X%, you should sell it. It's called the stop loss order.
Sure.
So let's say you say, if I buy a stock and it goes down 10%, I sell it. You have to think about, what does that mean? That means that if you sell every stock that goes down 10%, you can never lose 20% or 30% or 40%. But every once in a while, you'll have a stock, you'll buy it, it'll go down 10%, you'll sell it, and then it'll go up 100% from there.
Sure.
And you'll miss all of those too.
Sure.
There is no rule that you can set to help you negotiate that. It's not down 10 or down 20. There is no automatic rule that will keep you safe but not result in you missing opportunities. I've always taken the approach that if you have a great success, you should sell some. We say take a little off the table.
Sure.
In order to capture some of the gain, so that if it turns out to be fleeting, you won't give it all up. But if you buy something that's up 30% and you sell some, that means that if it goes up 60%, that part you won't get a ride on.
Right.
So it's not that the rule is wrong or right. The question is it right for you?
Right.
Now, the point is, like I said about the stop loss order, it prevents great losses, but it also causes you to miss some successes.
Yeah.
You have to decide which is more important to you. Based on your financial situation, your personality, those kinds of considerations. So, my idea of taking a little off the table.
Sure.
If you buy something that goes up 30%, you sell some. Then it goes up another 30%, you sell some more, another 30%. Well, you would have made more money if you held on. But on the other hand, if it went up 30% and then back down, you would have failed to tie up any of the profits. Which one of those two? You can't do both.
Right.
You can't secure part of your profit and let it all ride.
Right.
So every person has to work out for themselves what's right for them. You can't do this stuff perfectly.
Yeah.
What is the definition of good for you?
Right.
That's the question.
That's an interesting point. You recently had a conversation with your partner, Bruce Karsh, and the chess grandmaster, Maurice Ashley.
Yes.
In that conversation, Bruce talked about the importance of being at peace with yourself as an investor, which I agree is hugely important. Can you tell us how one gets there? And I think that ties into your point about what is right for you.
Well, it also ties into my college minor subject, which was Asian Studies.
Okay.
Asian Studies is a lot about contentment and being at peace, acceptance. And there's no manual for achieving these things. But, if you want to change something about your personality, and that's what we're talking about here, it has to be intentional. And you have to say, how can I achieve greater serenity? And importantly, one thing is that you have to not be a perfectionist. It's very hard to get investing just right. I used to have a friend, and we joked a lot in our relationship, and we
decided one day to catalog all the ways you can be wrong.
Okay.
So number one is you buy and it goes down.
Okay.
Number two is you don't buy and it goes up. Number three is it goes up, you buy and it goes up, but then it goes down. Number four is you buy and it goes down, and you sell and then it goes up.
Okay.
There's, number five is it goes up and you sell and then it goes up more.
Yeah.
There's an infinite number of ways to be wrong. There's only one way to be right, which is you buy, it goes up,
Yeah.
you sell, and it doesn't go up anymore.
Yeah.
But you're not going to achieve that.
Right.
So you have to achieve a level of serenity in your life, in all things, not
Sure.
just investing.
Sure.
But you have to accept that some of the things you buy are going to go down.
Yes.
And some of the things you're going to buy will go up, and you'll sell them, and they'll go up more. And you can't make yourself nuts trying to do it exactly right, because
Sure.
it's impossible.
Sure.
One of the greatest quotes, and I think when I was a boy, John F. Kennedy was famous for using this quote: "Give us the courage to change what can be changed, the serenity to accept what can't be changed, and the wisdom to know the difference."
Right.
And I think that's important in all walks of life, including investing. You have to have the serenity to accept that you're going to strive very hard to get it right, but you're not going to get it all exactly right.
Right.
And you have to be, if you make yourself crazy trying to do so, you're going to have an unhappy life.
Got it. Yep. And as a follow-up to that, it seems important that the structure and the surroundings that an investor puts himself in is very important in achieving that peace. How have you structured Oaktree? What are the what types of strategies are you pursuing? What types of strategies are you intentionally not pursuing? What are the tolerances for drawdowns and mistakes? How have you built the culture around that so that the investment decision makers at Oaktree can be at peace?
Well, we're very fortunate, Dan, because we invest in something called credit. Credit means we lend people money. And they enter into a contract with us that they'll pay us interest periodically, and then they'll pay us our money back at a point in time.
Right.
And so our outcomes are not wide open. Our outcomes are defined contractually. Most of the time people keep their promises and pay us as they promise, and we get the return we expected. Once in a while they don't pay us, and we have the rights of an unpaid creditor to pursue a settlement. And most of the time that works out okay. So when you are an investor in credit or a lender, your upside is limited. You get the promised return, but you don't get more most of the time. And you don't have an NVIDIA or a Microsoft on your hands, or an Amazon. But on the other hand, you have very few losers, and rarely do we have big losers. So this fits my personality, it fits the organization, it fits my colleagues, it fits our clients. They come to us for that. So that's a very livable situation, as opposed to being someone who concentrates on making ownership bets in startup companies where you can have 1,000 to 1 payoff or a complete loss.
Right.
And most of your investments will be unsuccessful.
Right.
That's right for other people. It's not right for us. And it's not what our clients come to us for. They may go to somebody else.
Got it.
For that.
Right. Right.
But I found 46 years ago when I joined the bond department at Citibank, a form of investing that fits my personality, my DNA, my intellectual makeup.
Got it.
Now you say, how do we set the culture? I think the most important thing about the culture is to not have recriminations. I want everybody to make decisions that will be correct. But I accept that nobody can make only correct decisions.
for all of us, it's a matter of having a batting average.
Sure.
And the fact that somebody supports an investment that loses money, number one, it's not that unusual. Number two, it's understandable. Three, it doesn't mean they're a bad person or they were lazy. And that person should not get criticized for, what if you were a pitcher in baseball and you got criticized every time you threw a ball?
Sure.
Or every time the other team got a base hit.
Right.
We try not to have blaming or shaming, to understand what's human and what's achievable. At the same time, if someone repeatedly makes mostly bad decisions over a long period of time, then we can draw the conclusion that that person's in the wrong job and maybe shouldn't work at Oaktree.
Sure.
But if you want people to give you the benefit of their best reasoning, you can't criticize every mistake.
Right. So, somebody who follows your investment philosophy, who agrees with your investment approach, is it inherently better to apply your investment philosophy to bonds rather than stocks?
Well, our philosophy, yes. Our philosophy, which is, a large number of reasonable successes and a general absence of big failures. I mean, debt investments, that's what they're made for.
Yeah.
It's their ideal for that purpose. I wrote a memo called Fewer Losers or More Winners.
Right.
And that's what it's all about. Everybody in your audience who sets out to be an investor should decide, number one, is their goal to be superior, or will they accept an average result? An average result is quite good.
Yes.
In the U.S., the S&P 500 has gone up about 10% a year for the last 100 years, which means if you had $1 100 years ago, you'd have about 15,000 today. That's not bad, right?
Right.
And that's average. So now most of us don't get to live for 100 years and invest for 100 years, but still, if you invest at 10% a year,
Sure.
your money doubles every 7 years.
Right.
So if you can do that for 35 years, it'll double 5 times, and $1 would become 2, 4, 8, 16, 32. Not bad.
Sure. Yep.
Will you be average, or will you try to be above average,
Right.
which introduces the possibility of being below average?
Right.
And if you want to be above average, which I don't push for the amateur. The amateur generally, as I said in my answer to your first question, is not equipped to do above average. They should happily settle for average. And the great thing about being average is that you can achieve average results for sure through things like index funds,
Sure.
and at a low cost,
Right.
and without risk of disappointment in terms of being below average. You can lose
Right.
money, but you can't be below average. Anyway, if somebody says, no, I'm not going to settle for average, I want to be above average, I know I might fall short, then, now that leads to the memo. Which route to superiority will you follow? Will you try to have more winners than the average investor, or fewer losers,
Right.
or both?
Right.
Now, it's hard to do both, because the defensive mindset enables you to have fewer losers. The aggressive mindset is necessary
Right.
to have more winners.
Yes.
It's hard to do both because it's hard to incorporate
Right.
both the defensive mindset and the aggressive mindset. So
Right.
you should say, what kind of person am I?
Yeah.
Which is a better course of action for me? I'm comfortable with our approach because what it means is that when we're unsuccessful, we're a little unsuccessful.
Yes.
When we're successful, we're a little successful.
Yes.
And, I like that for myself and for my clients more than swinging for the fences and sometimes having abject failure. But everybody has to, if you see NVIDIA and it was up 4.5 times last year, the question is, are you going to kick yourself because you didn't have it? Well, human nature says you are.
Sure. Yeah.
But you have to say to yourself, just a minute. Didn't I say that I want to have fewer losers and that I'll live without catching all the winners?
Right.
it's very hard to, given human nature, where we have a great fear of missing out, and we look at other people's successes and we feel terrible about it. It's bad for investing. There's a book about bubbles and crashes, and the author said that there is nothing so injurious to your mental well-being as to watch a friend get rich.
Yes.
Unfortunately, that's human nature.
Right.
We have to try to beat that.
Right, right. One of my favorite stories from your memos is the story about your friend who wished he had bought all of Malibu for $300,000, as the Ringe family is said to have done back in 1892. To which you responded, well, you would have sold it when it got to 600,000.
Right.
I think holding on to great long-term compounders in stock investing is very difficult. I think it's just as difficult as finding one. Now, it's difficult because the prudent thing to do is to rebalance.
What I said before, take a
Right.
little off the table. Sounds
Right.
intelligent.
Right. Therefore, and if so, if the prudent thing to do is to rebalance, then is profiting massively from great long-term compounders really just luck?
I wouldn't say it's just luck, but it does require luck. Because you buy something and it doubles. You make a decision not to sell it. If it goes on from there to appreciate further, there is some luck involved. You can never say, oh no, that was sure to happen. It was obviously an intelligent decision. At every point in the market, you look at the price of a stock or a bond or a piece of property and you say, is it fair, too high, or too low? And there's no scientific instrument for establishing these things. You make a judgment.
Sure.
The question is, are you lucky in your judgments? Lucky sounds like, it was all by chance, rolling the dice. No, not necessarily.
Sure.
But still, we all make judgments every day about whether something is priced right or too high or too low. And the word lucky may not be the right word, but do most of your decisions work out? And we all know that when a decision works out, there's some combination of the fact that you made a good decision, but there's also some factor that you were lucky. Life turned out to be as you expected, or maybe even a little better, and so you prospered. But, look, in one of the memos I talked about Amazon that was selling at 90 in 1999 and 6
Sure, yeah.
in 01.
Yep.
And, this question is, if you bought it at 6, would you have sold at 12? Well, lots of people would take a double. Would you have sold at 30 5 times, 60 10 times?
Right.
What about when it hit 600 and
Right.
you're up 100 times your money? Shouldn't you have sold? You used the word prudent before?
Right.
Wouldn't it be prudent to sell some? And obviously, you can't. If you sell some, you can't let it all ride. And then, I think when I wrote that memo, it was at 3,300. So if you sold some at 6 times, which was 100 times your money,
Right.
you missed the next 5.5 times.
Right.
So again, you're not going to get it all right. And if you know somebody who bought Apple at 6 and still has it when it's 3,300,
Yeah.
and never sold a share,
Right.
you have to look at them and say, just a minute. It was up 500 times,
Right.
and he didn't sell any. What if it had collapsed?
Right.
So
Right.
again, what is your mindset? What is your personality? How are you going to feel if something goes from 6 to 3,000 and back?
Right. Right.
And for most of us mortals, we would sell some at 600 and some at
Right.
3,000, and then hope for the best.
Right.
By the way, if you this goes to the difficulty of doing these things. If you buy something at 6 and it goes to 60, and you sell half your holding, you've made 10 times your money. Do you say, I hope it goes up,
Right.
and I make more money?
Right.
Or do you say, I hope it goes down,
Right.
which proves that I was right to sell some?
Right.
Again, human nature, the human condition, which is kind of screwed up. It's financially, you can tell when something was a good decision. You see the outcome.
humanly, the description of a good decision can be very challenging.
Got it. Shifting gears a bit, if we don't count the 2020 COVID recession, which lasted for 2 months, as a real recession, then the U.S. economy is in its longest ever expansion by a wide margin.
By a wide margin.
Now, if we count it as a real recession, obviously, then that's a different story. How do you treat the 2020 recession? Was it a real recession? Therefore, we're simply in a normal economic cycle, or was it merely a disruption? Therefore, we're way in overtime.
Well, it's a great question, Dan. You asked me before, what are my rules? And I said, rules are made to be broken.
Yeah.
There's a rule that there's a recession every 8 or 10 years. If you don't count that as a normal recession,
Right.
we're in the 15th year or the 16th year.
Right.
We're due for one tomorrow. I'm pretty sure there's not going to be one tomorrow. But you don't know. Nobody can say, was it a recession? Is this a normal experience? Are we due for one immediately? Or did it restart the clock, and will it be 2028 or 2030? Nobody can say. And to rely on applying those rules of 8 or 10 years mindlessly is obviously folly. I would say, my approach is to say, I don't know. I can't tell you. But when I look around in the environment, I don't see terrible excesses in the economy. I don't see that consumption is overly enthusiastic. I don't see that inventories are building up too high. I don't see a large number of construction cranes in the sky suggesting overbuilding.
Right.
When I look in the newspaper, I see some good news and some bad news, and some good news and some bad news. And one day they say maybe we're going to have inflation rekindling, and one day they say we're going to have a recession soon. It tells me things are kind of in the middle ground.
Yeah.
And in the middle ground, there's no stellar conclusion to draw. There's nothing you can say about the condition of our economy strongly, which has a high probability of being right. So I say nothing.
Got it. Euphoric markets tend to have what I call culprits, where the euphoric behavior typically begins.
Right. Well, I think the way I would say that is euphoria needs something to coalesce around.
Yes.
A seed.
Right. And I'm going to guess that your answer to my question, do you see any of these culprits? I'm going to guess the answer, based on what you just said, is probably no, that you don't see any.
In the last couple of decades, the great excesses have not been in the economy. They've been in the financial markets. In the 99-2000 period, we had a bubble in tech stocks. Too much optimism.
Right.
In 08, we had a bubble around housing and housing-related debt.
Right.
And then, but of course, even though we didn't have great excesses in the real economy, we had some doozy recessions because damage to the financial sector from the investment excesses correcting pulled them down. But yes, you're right. At the present time, I don't see that culprit, which would be, and by the way, I don't think that the stock market is crazy high. It's a little high, but it's not crazy high. And I don't think that the credit market is crazy either, just a little too unworried at this time. There are some things that a natural contrarian like me would worry about, but not so great as to be paralyzing.
Can you share a couple?
Well, just what I said. I mean, here we are in the third quarter of 24. If you go back 2 years, the world was very pessimistic, which meant that
the rewards for making investments were very high because people felt so low and things were priced reasonably as a result.
Right.
Now most people are pretty optimistic. The stock market has rallied for almost 2 years, and the aversion to extending credit has weakened, so that the reward for bearing risk in the credit markets has declined. So, I like to buy when everybody's pessimistic and there's no optimism priced in.
Right.
Today, most people are fairly optimistic, not crazy, but and so there's little pessimism priced in. I like to buy when there's a lot of pessimism priced in, and that's not the case today.
Yeah.
So I think that you can invest today, but there's nothing to get that excited about.
Got it.
I get excited when people are jumping out of windows.
Yeah. You think about investing in terms of odds. In my experience, most people think about investing in terms of being right. Did you always think this way in terms of odds, or did this evolve for you over time?
That's a great question. I don't know if I've ever been asked that question before. I think it's a matter of maturing. I joined the investment business in '69, switched to actually managing money in '78 in Citibank's bond department. Sometime in that '78 to, let's say, '88 period. I don't think I ever thought in terms of yes, no, but I think that's when I strengthened my probabilistic focus. And you start to realize that most questions aren't yes, no, but a matter of probabilities. 1963, there was a World's Fair in Flushing, New York, which is where I lived, and in Queens, and IBM had a pavilion there, and they had an interesting thing. They had 2 sheets of plexiglass with a series of rods connecting them, and an opening at the top. They poured in a bunch of balls at the top, and the balls went like this.
Okay, yeah.
And they bounced off the rods, and by the time they got to the bottom, they were piled up in this shape.
Right.
And that was my first. I was 17. And that was my first exposure to probability. Most things happen as you expect. Less things happen in ways you don't expect. Once in a while, something happens that you thought never could happen.
Right.
What we call the tails.
Right.
And that's the way I think about life. You have to really sharpen your focus on that. And in one of the memos, I told the story of, I think it was the Super Bowl in 2016. I'm not too good on football dates, but Carolina Panthers were playing the Denver Broncos.
Yes.
And they had a former football player on. He didn't go to University of Chicago. He didn't have a PhD in investing. But they said to him, "Who do you think's going to win?" And he said something very smart. He said, 8 out of 10, Carolina wins.
Right.
This could be one of the 2.
Right.
Now, most people don't add that latter point. I mean, most people hear, 8 out of 10, Carolina wins. Well, I'm not even going to watch a game. I know how it's going to. No.
Right.
2 times out of 10, Denver's going to win,
right.
And sometimes that happens. And you have to get away from black and white thinking. I keep saying throughout this interview, Dan, in investing and in life.
Yes.
When you're dealing with future events, you never know how it's going to turn out, and you have to recognize that, and you'll be a happier person and more effective.
Right, right. Well, we'll have to leave it there.
Okay.
But thank you very much.
It's a pleasure, and I wish you much luck with your new show.
Thank you very much.
Okay, bye-bye.